Hi, this is Keith Schneider, CEO of MarketCage.com, and this is September 11th edition of Market Outlook. So quite the day on Friday. Lots of potential change underlying the markets here. We're going to get into our normal fare, going through our little big view tool, and then I'm going to cover a couple of key charts in the S&P and in the bonds, because the bonds here are the key to what happened. So we're going to take a deeper look and use some of our proprietary indicators to see exactly what's unfolding in the bond market. All right. Well, first of all, let's take a look at our classic stuff in little big view. A couple things to note. Obviously, we were down pretty much 2 to 3%, and in the Russell 2000, which reflects mostly the domestic economy here, down 3.4%. So that's pretty interesting. And again, what we did here is I had been pointing out last week a little deterioration in accumulation versus distribution. But even though we had only the big sell-off on Friday, we've actually managed to get a lot more distribution underneath the market over the past 2 weeks. So you can see 4 distribution days. That's telling you that there's been some institutional distribution going on even before the sell-off, right? Because as you can see, we had all distribution day, obviously, on Friday, but that's only 1 out of the 4. So clearly, institutional type selling at the new highs in these indices going on over the past week. All right, let's go on to what the sectors are telling us. And interesting, you can see, let's just take a look a little bit in more detail on this chart here. Well, first of all, obviously, semiconductors still leading, even though it had a really nasty week, down 4.6%. But year to date, take a look, still leading in the leading sector, along with energy, which has recovered nicely after really getting smacked early in the year. But the big picture here is we're still trading. This is the S&P chart right here. So we're still trading above the 200-day moving average. And although we've weakened here with a nasty sell-off beneath the 50-day moving average, most of our sectors are still up on the year. And that is extremely positive. So the issue here is the slight deterioration. Overall, what we want to see is a lot more of these sectors moving down, and also the market trading under the 200-day moving average, which is now 205.76 in the S&Ps. So although we've clearly weakened, right, with the 6-month change across the board, positive with the exception of retail, right, we've got all of our sectors up over the last 6 months and certainly year to date. And so although it's deteriorated a bit, just slightly so in this part of our analysis. So even though this is still a positive, you've got a situation where it is deteriorating. Okay, let's go on to market hotspots and see what we can find there. So a couple of things that are interesting in market hotspots, which is obviously this week what was hot was long volatility, right, with VXX running up for the week about 7.8%, and the day change up almost 16%. But again, look at this. Based on overall action, it is still extremely cheap, although we did get a big move, and that would definitely trip this into a more positive read, which we'll get into in a moment as well. But again, what's the big picture here? The big picture is that still commodities are the strongest segment or asset class across the board. Where do we see that? So you can see right here in this table, right, the best 6-month returns is sugar, natural gas, Brazil, which is very dependent on commodities, and gold mining, which is up almost 30% over the last 6 months. So even though gold miners for the week were flat, it actually outperformed the market. The S&P for the week was down 2%. So gold miners and a lot of these commodities, as you can see, the 5-day returns were all better than the S&P. So what you can ascertain, even with rates going up, there's an inflationary issue still lurking beneath the surface here of what's going on, because commodities definitely still outperformed the overall market and bonds as well. So yes, you did have a poor day on Friday. You did have a mixed week in your leading commodity plays, but overall, commodities are still really strong. With the exception, let's take a look at this. This is pretty interesting here, with the exception of one thing. Copper. Look at this. Copper, 6-month return is down 10%. Now, copper obviously is a key industrial commodity. So the slowdown in growth, certainly in Europe and in other segments of the world, and the use of copper are directly related. And as you can see, copper is weak, certainly compared to other commodities like gold and gold mining stocks. So again, overall economic growth seen as slowing, right, which is what the problem is. Even low interest rates can't seem to get the global economy moving at full steam, and yet you've got inflationary pressures in metals and most raw commodities, except the one that's most related to construction and overall economic growth. Okay, let's take a look at some of the market internals. Looking at advanced declines, obviously the sell-off on Friday definitely put this thing where it was sort of not really at an interesting level, everything starting to move down. This is the S&P, and this is the up-down volume. You're still above the midpoint, so on up-down volume, interesting. This particular ratio really should be crossing our dotted line here with some renewed sell-off. You would certainly see that. Our intermediate, or what I would call longer-term indicator, looking at about 3 weeks or so. You know, it's good for a couple of weeks because it's using a data period, 2 different data periods of 19 days and 39, actually turned and flipped negative. It had just been sitting right around the midpoint here, or the 0 level, and turned decisively down. And you've got more to go potentially on the downside. And interestingly, advanced declines also now flipped under our key midpoint level here. So I'm looking at the market internals here, up-down volume, our McClellan oscillator, and the advanced declines, definitely in a weakening position with more to go, right? Obviously, you can see here, back in the sell-off in January, February, we hit this -4 to 5,000 level, and we're not even close in here in sort of advanced declining issues. And similar type of situation here, further weakness below the midpoint. You definitely have more room for the sell-off to continue and more pressure. So that would not be surprising, especially with this sharp break beneath the 50-day moving average. All right, let's see how Nasdaq is doing as well. So looking at the Nasdaq and market internals, you have actually what I would consider a slightly weaker situation, which is interesting because it had been actually performing a bit stronger. Why? Well, in terms of the market internals here, we're now under our key midpoint. The McClellan oscillator, again, beneath that 0 point and turning negative, with a lot more to go on the downside, and barely hanging on to the midpoint level in advanced declines. We start trading under there. We can the midpoint. We can certainly see much lower levels. Now, on a pure price basis, you're holding right here at your 50-day moving average. So we start getting a little bit more weakness through here. You certainly have got a lot more downside potential, certainly to the 200-day moving average, which is 48.74. And again, we're talking in this particular case on the Nasdaq composite. So, you're talking a good 400 points, 6%, 7% or more drop here if we actually do test our 200-day moving average. Not saying it won't hold here, but again, if we get some further weakness and trip these indicators beneath this, it'll definitely point to a bit more pressure before we find some support. Okay, let's go to some other charts here. We're going to look at new high, new low ratio. Now, these are often a little bit slow to respond, especially since we've been pegged at the high level. But you can see we started to deteriorate a little bit. But again, this is really not enough of a signal to say this is a sell signal. We really want to see it hit beneath the 70% level. We're not even close at the moment. So no read from this other than its slight weakening at the moment. So, okay, let's take a look at the Nasdaq 100. Very, very similar picture here. Yes, obviously we did weaken on Friday, but you're still pegged at really high numbers. We really need to see this new high, new low ratio turned from these upper levels down under the 70% level. That is not close at the moment. Now, let's take a look at some sentiment and volatility, because this has been one of the things of concern for people. Again, you've had that, after Brexit, you had this huge drop. Obviously, all of this sideways action here, volatility continued to drop to really low levels. At this point now, we actually moved above all of our key moving averages and the Bollinger Band. So this is certainly a negative for the market. Volatility is picking up. It can continue. And obviously, we might be in a new type of cycle in the fact that we've broken out from these key levels down here. Now, not saying that you can't get some sort of retracement or pause, but it's very possible, again, that you can see right after low levels and a breakout, you get some continued or at least another thrust or two that's significant to the downside in the market, which would drive this higher. Similar pattern here. You can see we basically traded under the key moving averages, and then there was a really good period where the market stayed above that 200-day moving average, which is this magenta line over here. So again, it looks to me like we could be in for a period of a bumpy ride and increased volatility. And we'll see what the plunge protection teams have in store for us and just how far this sell-off is going to continue. But meanwhile, this is definitely a negative for the market, and I would put this as a positive in terms of the movement up in volatility. Okay, looking at our next chart, this is a ratio chart of short-term versus long-term volatility. Again, up over here shows really positive sentiment, and as you can see, we were hovering at those high levels, couldn't really generate much of a sell-off, but we broke down through what I would consider a critical level. We got to almost overbought readings, backed off a little bit, and then have been above this critical point right here, and we broke down on Friday through it. So again, more possibility to the downside. You can certainly see how that operates here. And again, even in here, you got this sort of little bit of a rally, although another test. So certainly we've got what I would consider more potential momentum on the downside to the markets and propelling this to potentially more oversold levels. I mean, you're not nearly oversold here. You're just sort of approaching a neutral level. But considering from where we came from, that is a bona fide sell signal. So expect more volatility in the future and potential downside. At least that's what these indicators are showing. Now, what I'd like to do is now bring in some charts here from our proprietary indicators. First thing I want to show is looking at the bonds, because this is the key. What's going to happen with interest rates and the whole liquidity picture? And in this particular situation, you can see a couple of things. This is a combination of, this is up over here is strictly a price chart. Let me change that tool here for a second. And this down here is our real motion momentum indicators. So what we're looking at here, our blue line here, this is the 50-day moving average of price. This is the 200. Now, similarly, this is our 50-day of real motion or momentum, and this is the 200-day. So a couple of things to note. When you get really overbought and hit the top end of the Bollinger Bands, in conjunction with the longer-term real motion indicator, right? So this is the 200-day real motion indicator. This is looking at our momentum on a 200-day basis versus our benchmark, which is the 200-day moving average. So you can see, on average, this is how much we're trading above it. So a couple of things have occurred. Number one, we moved outside of the Bollinger Band here on this blow up after Brexit. Now, when you come back inside of it, that is telling you that your momentum is waning. When that occurs at the same time, the price of the price action, it moves outside of the Bollinger Band, occurs at the same time, and your momentum moves back inside and then starts to fail. Well before the price action falls underneath the 50, you've got a real shift in momentum. And once you start closing under that 50-day moving average or price, it's really confirming the topping action overall. So now where we are is we've already broken down underneath our 200-day of our real motion indicator, even though we're trading in price well above our 200-day moving average. So this is telling me that on a daily chart, the TLTs on a momentum basis have really broken down hard. Okay, so let's step back a little bit and see what the monthly charts are telling us in the TLTs, because this is definitely a time to sit back. We've got all that news about what's happening with the central bankers, with Draghi, and the fact that stimulus may have worked its way out. But what are the charts really telling us here? So if you look at it, look, you got the financial crisis peak in bonds, right? The low in yields. You got another higher price here, another one here, and yet another one after Brexit. So you got this beautiful channel. right? At the same time that this is moving up, our momentum that I'd shown you is moving down, right? Every time we make a new high, it's running out of gas. So at this point, right in here, rates are largely negative all over the world, not necessarily here in the US, but they're really low. This is 35-year low, maybe a low in financial history as well. Certainly negative rates are unique, even though it's not here. Throughout the world, there's trillions of dollars worth of debt that's negative. But nonetheless, we hit the top of the channel on the monthly charts, right? And at the same time, the momentum is not improving. It's getting more negative on the daily and breaking down hard. So in essence, we may be at the end of this long-term cycle, right? Since the early 80s, when Volcker broke the back of inflation, though that was the high in interest rates. Since then, we've been going down, and this is certainly looks like this channel now is containing, right? This big channel is containing the highs and the lows, right, in rates for the moment. So with the breakdown on the daily chart of momentum right at these highs, it would be really surprising to see it break out again to new highs. And in fact, if Grundlich is right, and a lot of other experts in this particular area on a fundamental basis, that this high here may have marked the high in bond prices and the low in yields, and that's important for the market. All right, so let's take a look at one other chart, and let's take a look at the S&Ps. And what I really want to do is look at, let's take a look at the real motion. As you can see, this is our real motion indicator right here. And this particular low on Friday, compared to the low here, we've got tremendous amount of weakness. But what's more interesting is, let's take a look at the weekly chart. And what's happened on the weekly charts is a classic example of how our momentum indicators operate. So the first thing to note is we got across this bottom chart here is our real motion indicators, right? This is 200 weeks is this green line here. This is 200 weeks, okay? And this is 50. And as you can see, we broke down last October in our momentum on these charts, right? Because look, this is actual price up here. Here's your 200 week. This is your 50 week. So we've already, even though up in here, this period we started waning, and specifically, let me clean this up here. Specifically in here, we started to really break down. And that's when we got that really nasty period, right? So you can see we got this crossover here, and that occurred last October. And we got some nasty sell-off. We even got a sell-off before. And as you can see, we were sort of waning in here, starting to roll over on our 50-week or our annual momentum. Now, in this particular case, we have, even though we had this really sharp rally, momentum was really weak. Now, the bigger trend in momentum has reasserted itself. With this down move here, you can see our real motion at the end of the week closed under our 50-week, which is definitely showing extreme signs of weakness, certainly when you compare it to the price chart up above, right? So momentum already waning in the S&P as well. So when you look at some of the news and some of the gurus that are talking about the markets, both equity market and the bond market being under pressure, overvalued, etc. You can see some of the type of analysis that we do to look at price action, both on price, on momentum, and you can see how things are deteriorating. So you definitely got a scenario now where weakness in the price charts confirmed by momentum on the longer term basis is in play across both bonds and stocks. All right, that's it for now.